Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to Live Squawk's Q1 earnings season preview on Tuesday, the 21st of April, 2026. Over the next 30 minutes, we'll be looking at what experts have to say about the corporate outlook and how the wider domestic and international dynamics might play into company executive views and expectations for the quarter and beyond. I'll be joined by regular contributor to the podcast, Christine Short, Head of Research, Global Corporate Events at Wall Street Horizon, a TMX company. But before we get into it, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Hi, Christine. How are you doing?
Good morning. I'm well. How are you?
Very well, thank you. Very well indeed. It's great to have you back on for another episode,
Yes, thanks
especially in
for
these
having me.
tumultuous times, shall we say.
Yes. Bah.
We'll try and stick to the I guess the corporate earnings side of things, but we can't really sort of start without looking at the current situation and what we're seeing geopolitically at the moment. As it stands, we're recording this on Tuesday, as I said, the 21st of April. There were talks planned between Iran and the US in Pakistan. That looks to have gone by the wayside, with both sides kind of sticking to their, if you want to call it, principles, and not budging at the moment. So it looks at this point in time, although we've still got a few hours to go, that we could be returning to the conflict. But hopefully they'll get themselves together enough to try and avoid that and try and elongate or prolong the negotiations and discussions, because again it will be for the benefit of us all, should we say. That aside then, well, put that to one side, the current affairs, but we want to look at how what we've seen over the last sort of 6 weeks, the crisis we've had, really has affected corporate America's views and projections for the coming year. And we'll also take a look at some key sort of corporate events, shall we say, at the end. But just turning then to the and we'll look at Wall Street Horizon's latest note. It says banks and chip names kicked off earnings season with robust results last week. We've heard from a number of the banks. Christine, what are your initial views on what you've seen so far from the banks, but in the wider corporate sense?
Yeah, so I'll just touch on, as you said, markets have been very volatile. I joked yesterday, we usually send out this note on Sunday evenings that we finalize on Friday. And, occasionally over the years, you go in and I have to make changes over the weekend. But more recently, I'm working with our kind of editor over the weekends because everything is changing so rapidly. So I had you mentioned my note from Sunday, and I think the title was something about markets looking past the geopolitical fog. But then, of course, over the weekend, the Strait of Hormuz was shut down. Indian ships had been shot at. It's like, so then you come into Monday and stocks are down. But I said, you know what? Like, should we change the headline? And I decided not to, just because I knew that by the end of yesterday, it was like, okay, once again, we seem to investors seem to be looking past this crisis, and for the most part, right? And look, today Dow's up a couple hundred points. Trump saying that he predicts a deal with Iran will be made before the ceasefire expires, which is tomorrow. So I'm glad you start this episode saying the date, because you need to almost precisely pinpoint what time we are speaking, because anything could change by the minute. But
Oh,
for
this
the
will get
most
old in 10 minutes, I think.
Oh, right. So it's like, do we say it's 10:45 on the East Coast right now when we're having
You
this
almost have to.
conversation?
You almost have to. You almost
You
have to.
have to. So, and again, because it's flip-flopping so quickly. That's why I chose, I'm like, "Oh, let's just stick with," because this is the overarching theme, right? The markets believe the earnings and the economy are more important than oil, right? At least for now. They seem to be looking past the war. We saw this 11% sprint higher in the S&P over the last 3 weeks.
Mm.
Yesterday, we saw a very minimal consolidation considering that. And I think there's like some level of comfort that's built up, based on how dramatic we've come back from those lows, which I think is the way is the market's way of hinting that the moment of peak uncertainty has passed a little bit, right? Oil topped out on April 7th. We've seen a
Yeah.
comeback since then. And now, of course, it's time for earnings and economic data to substantiate this. And, was the market right? Kind of giving the bull market the benefit of the doubt back here.
Well, there
Um,
was a sorry to that some thought there was a level of complacency within the markets really after the initial shock. Um, but I think that was reasoned out, one, because the market's a bit more mature than we've seen in the past crises, and there's a level of calm, I think, that's pervaded what we've seen this time
yes.
round that we might not have seen maybe 5, 10 years ago, because people have matured and the markets have matured and understand the risks a bit more than they may have done previously.
Yeah, and that's absolutely right. Rightly so, when there's a spike in oil, investors kind of go on this recession watch and they almost immediately discount stock prices to reflect that concern. But after that sort of initial concern, now, we see the economy's been so resilient here in the US, led by the consumer. The labor market has calmed down. Our March numbers were much better than expected. Non-farm payrolls rose to 178,000. That was a reversal from a decline in February. It was much better than economists were expecting. Unemployment edged down to 4.3%. You've got one job available per one person unemployed. And, GDP, our GDP here, 70% of that is consumer. So you want to see a strong consumer. We got retail sales out today, and those were obviously higher due to higher prices at the pump. They came in at
Yeah.
1.7%. That was a pretty sharp upswing from February, and it was the fastest pace of increase since January of 2023, I believe, and just
Mm.
slightly higher than expectations. But if you looked at the number excluding gas stations, retail sales rose 0.6% last month. So a little bit slower than the 0.7% we saw in February. But again, people are still spending. Furniture and home furnishing store sales were up 2%. Electronics, building materials. I think the two kind of weaker areas, apparel and restaurant sales, were just about flat. But
Mm.
overall, the American consumer is still healthy. And certainly those tax refunds have been helping. So our refunds have been running about 11% higher on average than they did last year. And we know US consumers treat this as windfall. They put it towards discretionary spending for the most part. And I think we're seeing that in play right now. So
Good.
again, the markets are looking at that hard data, right? And
Yeah.
sentiment data is always going to lack. Like we get U of M, University of Michigan's consumer sentiment report, I think on Friday. Those have been sort of dismal. Like that reading has been lower than it was during the financial crisis here. So those sort of lag, and I try to look at that, but also compare the soft data from the surveys with the hard data, which is the retail sales and non-farm payrolls, and overall the situation is quite good.
So you don't think the volatility we've seen in the non-farm payroll, you've been able to average that out and see through the noise of the ups and downs and peaks and troughs we've seen from the last few numbers?
Yeah, I mean, look, 1 month doesn't make a trend, but
Mm.
we certainly rather, after the February numbers we saw that were, what was non-farm payrolls were down, like we lost like 133,000
Yeah.
jobs in February. So to see, I think some of the 178,000 gain we saw in March was seasonal, so it's we're not expecting to see that month, after month, but it obviously moving in the right direction. Wages were still a little light. Wage growth was rose less than expected, so that's obviously something to watch. But again, we'll be looking forward to seeing April numbers and see if we can incrementally improve. Obviously, there's been a lot of concern about layoffs, and but when you look at the jolts and how many jobs are available, um, it's still about 1 to 1. And of course, the concerns around AI are still floating. And I think a lot of that makes its way into the consumer surveys,
Mm.
because we are hearing about this. We are seeing companies like Block lay off 40% of um, their workforce, and we're seeing some workforce reductions. But you also have to remember a lot of these, especially these big tech companies, overhired during COVID and they held on to those employees. So I think now a lot of them are just right sizing. But yeah, we'll see in the April numbers. But certainly March was a move in the right direction for the labor market.
Okay. And yeah, unemployment rate was little change, I think, at 4.3%. Last month. But yeah, one to look forward to. How is that reflected in what we've seen from the executives' sort of projections? What are they? I mean, we heard from banks last week, and we saw some decent numbers from Goldman Sachs, but I think an adverse reaction in their share price initially, and
Right.
obviously we saw the other banks as well. But how are the what have the banks said so far about what are their views on not only their own performance but the US performance?
Yeah, yeah. So, yeah, like you said, Goldman Sachs kicked it off, which is sort of unusual. Usually we
Yeah.
hear from JP Morgan first. I think it was the first time since like 2018 that Goldman kicked off the earnings season. And like you said, investors reacted to some of the weaker data there. Their FICC, their fixed income, currency, and commodities trading revenues were weaker.
Mm.
Softer market making conditions and interest rates and mortgages weighed on those results. But overall, 48% surge in investment banking fees, on the back of a significant increase in M&A and debt underwriting activity. So there's certainly some other strong points there. And then we went on to hear from the core banks. That's where we hear a little bit about the consumer. Um, there were some banks increasing loan loss provisions. I believe Citi was one of them. But Bank of America and JP Morgan reported healthy consumer spending. A few of them, trimmed their full year net interest income guidance, which is not surprising. But overall, solid beats, I think, across all of the six big banks. But like you said, it's also in the commentary. And we always look to Jamie Dimon, CEO of JP Morgan, to give us kind of a sobering view or like a
Mm.
he's always more cautious, right?
Mm.
He said, what was it? There was an increasingly complex set of risks. He named geopolitical tensions and wars, energy price volatility, trade uncertainty, large global fiscal deficits, and then elevated asset prices. And so he said they couldn't predict how the risks and uncertainties would play out, but that was reinforcing why they prepare the firm for this wide range, excuse me, of environments, right?
Yep.
But then you have Wells Fargo CEO Charlie Scharf saying earlier today that the U.S. economy remains extremely strong. So, I think overall it was like cautiously optimistic. Jane Fraser as well. So there are these set of risks that are still out there, but
Mm.
the underlying, economy and the strength of the consumer provides a good foundation here. But it's just these black swan events like a war or these spiking oil prices that the global trade uncertainty. There's still things out there. There are still headwinds.
And they're always gonna be. I mean,
There's always
you're
going
never
to
gonna
be. Yep.
I mean, to that end, JP Morgan did raise, I think this was today, raised the S&P 500 2026 year-end target to
Right.
7,600 from 7,200.
Yeah.
So,
Right.
I know the economy's not the market's not the economy, but there obviously, we've seen new highs within the 6-week period that we've had the sort of conflict. So again, there is a level of confidence out there, clearly.
Yeah, I think so. And then I think just across many other sectors, we had United Healthcare coming out today, better than expected numbers. Delta, a few of the semiconductor names last week. You had Taiwan Semi and ASML. So I think most of the sectors that have reported thus far, we're seeing a strong showing. Right now, the blended EPS growth rate for S&P 500 is at 13.2%. That would be the sixth quarter of double-digit earnings growth. Revenues are about 10% growth year over year. That's the highest top line we've seen since Q3 2022. And then if you look at some of the we always look at the beat rate. Obviously, more companies beat estimates than not. But right now, for the 64 companies from the S&P 500 that have reported, 88% have beaten EPS estimates, 84 have on sales, and so that is,
So
you
strong.
know, that's much stronger. Yeah, usually we see in the 70s, but so far we're off to an even better start. Is this priced in? Yeah, I think this was already priced in 6 to 12 months ago. We know this is all backwards looking
Mm.
data. The most important data point we can look at is what the estimates are for next quarter. Um, Earnings Scout puts out this data, and they've tracked of the 64 companies I reported, 53% have increased their Q2 EPS estimates, and that's well above the 3-year average of 39%. So overall, the outlooks companies are providing today are better than they were 3, 6, and 12 months ago. And that's when, fears of a potential great global trade war were at their height like a year ago, right? So it's very positive to see guidance ticking up for Q2 and even for 2026 overall. I think this morning United Healthcare increased 2026 guidance. So this is providing the reality check, right, for the market that things are strong, and to hear that CEOs are raising guidance is certainly very bullish.
Yeah, I'm just looking at a Morgan Stanley piece here on what they see for Q1 EPS. They expected 12% year over year, and sales
Yep.
at 7%. And they, again, like you reflect on the early financial reports that we've seen so far, skewed positive, with 62% of names seeing positive T+1 returns. And they say estimates have not been lowered into the reporting season, contrary to the seasonal trend. And we saw a similar dynamic in Q4, where estimates held steady into the quarter, and the SP 500 still printed a strong 7% surprise.
Yeah.
So, I mean, again, I do find this maybe a little bit unerring that, it seems to we ride these crises now with never-ending ease, and no one there's no fatalism anymore. No one expects this thing to sort of to dip, or for people to sort of pull money out to the sidelines or whatever anymore. It's just opportunities to get in again. Uh,
Right, right. Opportunities to buy, at lower
yeah.
prices. You're right. It is surprising though, because like you said, it's the markets have changed. Over the last 10, 20 years, this probably would have resulted in a steeper downturn or a more prolonged downturn. But our markets are just very volatile now, right? You're trading on the next headline, or you're
Mm.
waiting for the concrete um, data to come out, and that's what we're seeing with the earnings season data. And so if we continue higher, and like you said, Morgan Stanley mentioned it, but yeah, we've seen estimates actually either hold steady or even increase into the quarter, which is unusual. And we've seen that the last 3 quarters, and yet we're still having 88% of companies beat those estimates. So again, off to a strong start. Next up, obviously, we'll be looking at the Magnificent Seven, a little more on the AI trade. That's where the real strength is again this quarter. Tech overall earnings growth expected at 45%, revenue growth at close to 30%. So again, we're seeing tech drive this thing.
Yeah, I mean, Morgan Stanley, they're a bit more modest with their growth expectation. They look for 25% for this year,
Yep.
11% for the balance of the S&P 500 to 493, and they say we are seeing early signs of estimates being revised higher for the balance. Really, do you think Mag 7 is starting to just drag up um, the rest now in terms of the AI functionality and everything that comes with AI? Um, will be accretive, is that the right word? Accretive, I guess,
Yeah.
and to bottom lines generally throughout the S&P 500 and the US economy as a whole.
Yeah, I think that's a great point. I think we're starting to see that, right? And across, even, like I mentioned, we got a little bit of a peak at AI through the semiconductors. Um, Despite the rout in software about 6 weeks to 2 months ago, you're starting to see names that are using AI in the right way,
Mm.
benefiting. And so I think you're going to see that across industries. And last quarter we started tracking who's mentioning AI. It's like across industries, across sectors. If you're kind of mentioning AI in your strategy, That's getting rewarded for the most part by investors. Now, for some names, we know investors are like, "Show me the money." Like you've invested like the hyperscalers, right? They Google, Meta, Microsoft, Amazon, investing 600 billion or expected
Sure.
to capex, mostly going through into AI build outs. Now we're hitting the show me the money phase where like, what's the ROI on this? But with other names, yeah, across sectors, you have to have a strategy. It's helping a lot of them. But now we're moving into like substance over the next 5 years. I think
Tangible returns. Yeah,
yeah,
what you
tangible
say.
returns
Yeah.
and a lot of analysts that cover this sector say the substance you're going to see over the next 5 years is even out going to outweigh the current hype. So it's always the question is this being hyped up too much? But people really in the industry say we're at like the bottom of the second inning or whatever if you're a baseball fan. Like we're so early on in this um, next sort of industrial revolution that we've got a long way to go and a lot of growth to expect. And we're seeing the rotation back into tech stocks, even though, like under a little pressure yesterday, but these are the names that powered us to record highs last week. And the Mag 7 driving a lot of those gains over the last week, up 6%. They added 4 trillion in market value since the bottom last month. So investors like these names, but now we just have to see, uh, how are they spending
Mm.
those capex numbers that they shared with us last quarter, and is it turning into something? There was always going to be winners and losers, and so that will certainly be the focus in the next week or two of this earnings season.
And is that what it's more about now? It's less about the industry as a whole and more about, like you say, winners and losers. Now, who's coming out on top? Is Anthropic now the lead AI machine in there, or is, Chat GPT and
Yeah.
is it more about the competition now? Is it becoming established enough now that you can start to separate from the industry itself and look within that as the winners and losers, and who's pairing up with the Googles and the relationships they're starting to form. Because I've seen that now. Google will pair up with Anthropic or a government department or whatever. There's all these different things now that you're starting to see where they're forming alliances.
Right. Well, I know I had a running list of who is working with. I mean, everyone's working with everyone. It's really hard to keep track, but I think
Isn't
it's
that
almost
dangerous
like
to part? Like, in terms of within the industry itself, you're starting to see, Google buy into shares of this company, or Microsoft have bought into Anthropic, all these different kind of, it's kind of, there's self-funding. And is there any
right.
danger you see in that?
Yeah, that has been a concern, but I also think if you're not doing these things, then investors are looking at you, "Oh, why aren't you partnering?" So,
Right.
we'll see how that shakes out, but that's certainly been a concern some analysts have had that it's, like you said, self-funding and sort of a circle here of everyone working together. As far as winners and losers of publicly traded companies, yeah, like we look at the hyperscalers, we look at the big names and depending on the quarter, sometimes investors like what they hear from Alphabet more than they like what they hear from Meta. As far as the
Sure.
private companies, we've been on this IPO watch this year and it's who's
Mm.
going to be first, right? So obviously the other week, the big news was SpaceX confidentially filing to go public. And then the next question is, okay, there's this potential AI battle of who's going to go public. Is it going to be OpenAI? Is it going to be Anthropic? We've heard rumors that both are eyeing a public debut this year. But when exactly that might happen, we still haven't seen the filings come through.
Well,
We
in these
saw
uncertain times, you can imagine they want to see how things play out on a geopolitical level, just for a little bit of certainty, I guess. Mm.
absolutely. Right, and it makes you wonder with SpaceX, I think the rumor was they were eyeing to go public, in June.
Mm.
They were seeking a staggering, like, 1.75 trillion valuation, which would comfortably unseat Saudi Aramco as the largest IPO in history. So
Yeah.
this is the year of the mega IPOs, or is it? Like you said, many of them are probably in wait and see mode a little bit here, to see how things shake out in the Middle East. But we've seen a few kind of mid cap AI names already filing. some notable ones from Q1 were Cumulus AI and Sharon AI Holdings. So, smaller AI infrastructure companies are
Sure.
moving to market faster than the giants. But, we're seeing across industries. I think yesterday, Jersey Mike's, I don't know if you're familiar with that Subway chain here or sandwich chain here in the US, confidentially filing to go public. Some other consumer names, Bob's Discount Furniture, went public in Q1. So we are seeing, we heard this from the banks, a better landscape this year for going public.
It
Um,
reflects a level of confidence, clearly,
Absolutely.
despite everything that was in, that they're willing to take that make that jump.
Absolutely. I'd agree with you. And, a lot of these names don't need to go public. Anthropic and OpenAI have plenty of capital.
Mm,
But it does bode well that they are considering that jump this year.
okay. We're coming near to the end of the episode. Talking of large companies and the influence they've had on not just the markets, but generally on society and Apple. Again,
Right.
it's just still set to report. But there's been some breaking big news coming from Apple in the last couple of days. Um, I'll let you, I
Yeah.
think you wanted to mention Tim Cook.
Yeah, we have to. I mean, like I mentioned to you before the call, like Tim Cook has, since I've been covering earnings, Tim Cook's really been at the helm of Apple. Once upon a time in my career, Apple was the only company you cared about for earnings. It was like everything stopped when Apple reported, similar to, I would say, sort of Nvidia now, but maybe even more so. This was like in the 2010s, right? It was post financial crisis and like peak iPhone. And so, anyways, yes, he's stepping down. And passing the reins over to John Temis. He's a senior vice president of hardware engineering, kind of a steady voice there at Apple.
But
I
safe
think
in
it
their hands.
Yes, exactly. And I think that bodes well for what we're going to hear in the report. I think it's next week or the week after. Because companies prefer to announce leadership changes from a position of strength typically. And so he doesn't, Tim Cook doesn't want to leave during a downturn. He wants to leave on a high, possibly record iPhone sales. And so we'll hear about that when they report. But it was such an interesting ride for him because he came in following Steve Jobs, was a hard act to follow in that he was constantly, I think, throughout his career there, compared to this sort of visionary, right? And Cook was always dismissed as the operations guy. Jobs gave us the iPhone, the iPod, and the iPad, and it was Tim Cook was more of this kind of steady operations guy, and he wasn't going to introduce a revolutionary product, but he did launch Apple Watch and AirPods. But
Yeah.
look, I mean, like, look at how the company did under his lead. Market cap, I think when Jobs left was just at about 350 billion. It's 4 trillion today. So um he led the company well. Their services revenue, so music content apps, was about 2.8 billion per quarter. In the most recent quarter it was 30 billion. So
Wow.
he's left his mark. And I think him leaving at this time means that we're going to see a decent report. And honestly, Apple, as you know, has been kind of one of the ones that's behind on AI. So I
Mm.
think they have the most upside because if they can change the narrative a little, um, and report something we're not expecting, that's where you see the biggest jumps. So excited to see what Apple reports. And I think Tim Cook will go down as kind of like low drama, quiet, there are not many controversies following him.
Diplomatic when needed to be.
Absolutely, very steady. So yeah, so last call with him, and Apple moves on.
15 years nearly to I think nearly 15 years
Yep.
to
Yeah,
the
I
day.
know. That's a good tenure.
Yeah, so I was gonna ask you, you sort of given your feelings on him, but A plus, would you say just is up there with Jobs in terms of what he's done to move the company forward? I mean,
Yeah,
obviously, Jobs
with
did it.
less fanfare.
Yes.
Obviously, right, like Jobs was the visionary. There was more chatter about him and his his whims, and he is someone that sticks in the public's mind. And as I said, Tim Cook was a little more steady, a little under the radar. But if you look at the numbers at the end of the day, like
Mm,
he did amazing things for this company. So job well
awesome.
done by him.
Yes, very much so. Listen, we're at the end of our episode, and I thank you very much for your input today and your just imparting your knowledge. So appreciate that.
Thank you so
Um,
much for having me.
for anyone who missed the start of this, you can go back on the social media platforms or the podcast platforms. You can find, sorry, my guest Christine, excuse me, Christine Shaw at wallstreethorizon.com. Please take a look at what they do in a bit more depth, because I think it would add value to anyone's any investor looking really to know what's happening at the moment and what's going on in the corporate world. So please check that out. Yeah, Christine, thank you again, and we'll have you on again for the next earnings report. Yes, anyone wanting to look at, we'll put the links up on social medias for anyone who wants to know how to get in touch with Christine. But Christine, thank you again,
Thank you.
and we look forward to seeing you on the next episode.
Great. Take care. Thank you, Harry.
Thank you. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.